Ray Dalio, one of the greatest and most influential investors of our time. And today we will explore the valuable lessons he learned throughout his career, especially on how to navigate economic crises. If you're looking for ways to tackle current financial challenges and become a savvier investor, this video is for you. And if you are enjoying the videos, please give a like and subscribe to the channel. This helps me a lot. Our channel is new on YouTube, and your support is essential for us to stay updated. Now, back to the video. The beginning of Ray Dalio in the stock market. Ray Dalio's journey began when he was just 12 years old. Imagine this, a teenager eager to learn about the world of investments, buying his first stocks. Without a clear strategy, Dalio based his decision solely on stock prices, something many novice investors do, hoping that by purchasing cheap stocks, they would rise in value quickly. However, he soon faced a harsh reality. The company he invested in was on the brink of bankruptcy. Fortunately, the company was acquired by another, resulting in an unexpected increase in the value of his shares. This episode marked the beginning of Dalio's financial education. He realized that although he had been lucky at that moment, relying solely on luck was not a viable strategy for success in the stock market. The true key to success is continuous learning, rigorous preparation, and, above all, learning from one's own mistakes. As Dalio himself says, mistakes are the greatest teacher. He understood that every mistake is a disguised opportunity that brings him closer to success. Thus, he continued his journey, absorbing knowledge and becoming one of the greatest investors in the world. If you want to succeed in the financial market, do not depend on luck. Like Ray Dalio, study the market deeply, seek information from various sources, and always be willing to learn from your mistakes. After all, sharing experiences is a powerful way to learn. And you, what was your biggest mistake or success in the financial market? Leave it in the comments, and let's build a community of mutual learning. The devaluation of currency in 1971. In 1971, Ray Dalio lived through one of the most critical moments in modern economic history. While working on the New York Stock Exchange, he was present when President Nixon announced that the United States would no longer exchange dollars for gold, effectively breaking the gold standard. For many, this announcement seemed to mark the end of the financial system as they knew it, and Dalio believed the market would crash. However, to his surprise, the market rose instead. This event was a turning point for Dalio, prompting him to reflect deeply on the market's response. He had never witnessed a currency devaluation before and began to question why the market reacted in such an opposite manner. It was then that he decided to delve into the study of economic history. Dalio discovered that a similar event had occurred in 1933, when President Roosevelt made a nearly identical announcement, also resulting in a positive market reaction. The lesson he learned was simple yet powerful. Events that seem unprecedented in our lives may have occurred many times throughout history. By understanding the past, Dalio began to develop a more robust mindset for analyzing the present and predicting the future. He realized that many events that we have never experienced may seem surprising, but they have happened before. Therefore, like Dalio, it is essential for you as an investor to learn to study history. It can provide valuable insights into how the market may react during times of crisis. The patterns are there. All we need to do is know where to look. The Great Mistake of 1982 and the Debt Crisis. In 1982, Ray Dalio faced one of the biggest crises of his career. With his accumulated experience and growing confidence, he made a bold prediction. He believed an international debt crisis was about to explode, which could result in a devastating recession in the United States. During this time, many developing countries, like Mexico, had incurred enormous debts to American banks, and Dalio was convinced that these countries would not be able to honor their commitments, resulting in a cascade of defaults that would affect the heart of the U.S. financial system. What happened next was partially in line with Dalio's prediction. Mexico did indeed default, and other countries also faced difficulties with their debts. However, the crucial part of his prediction did not materialize as he expected. He believed that this collapse would lead American banks to fail and plunge the country into a deep economic recession. But what he did not foresee was the swift action of the Federal Reserve, which, instead of allowing the crisis to escalate, made a surprising decision. It printed enormous amounts of money, rescuing the banks and stabilizing the economy. This mistake almost cost Dalio his company, Bridgewater. He lost credibility, many clients, and went through a period of significant financial difficulties. However, it was precisely this mistake that led him to one of the most important lessons of his career. In times of crisis, not only do economic events matter, but also how central banks and governments respond to these events. He understood that the Federal Reserve's swift action to print money was not unprecedented. This type of response was part of a historical pattern. This lesson completely changed his investment approach. Dalio began to study deeply how economic cycles unfold over history and how governments tend to react in crisis situations. He became a strong advocate for the importance of studying past economic patterns to predict future crises and, more importantly, to understand how monetary authorities would respond to these crises. Have you ever made a bold prediction in the financial market that didn't turn out as expected? What lessons did you learn from that experience? Share in the comments. We all learn from our mistakes and successes. Anticipating the 2008 crisis. After decades of learning from mistakes and successes, Ray Dalio was ready to face another major financial crisis, and this time he was prepared. Thanks to the lessons he learned in 1982 and his extensive study of economic cycles and governmental responses, Dalio predicted the financial crisis of 2008 with impressive accuracy. In the years leading up to 2008, he observed clear signs of a housing bubble fueled by easy credit and rampant speculation. Banks were granting mortgage loans to people who clearly could not afford to pay their debts in the long term. The market was driven by unrealistic optimism, very similar to what he had studied in previous crises. Dalio knew that this cycle of excess credit and inflated asset prices could not continue indefinitely. Instead of following the market's euphoria, Dalio alerted his clients and adjusted Bridgewater's strategy to a defensive approach. He knew the housing bubble would burst and that when it did, the domino effect would be devastating for the global financial system. While many investors were blinded by the real estate boom, Dalio and his team were preparing for the impending storm. When the crisis finally erupted, with the collapse of Lehman Brothers and the bankruptcy of several other financial institutions, most investors saw their portfolios crumble. But Dalio, thanks to his careful analysis and preparation, not only protected Bridgewater from significant losses but also capitalized on the crisis, generating substantial returns while the market collapsed around him. What set Dalio apart during the 2008 crisis was his ability to combine his understanding of economic cycles with the anticipation of political and monetary responses. He knew that the Federal Reserve and other central banks would intervene to save the financial system, printing large amounts of money and injecting liquidity into the market, something he had already learned from the 1982 crisis. This allowed him to position his investments to benefit from both the downturn and the recovery. The power of studying economic history. Ray Dalio learned a fundamental lesson throughout his career. To understand markets and predict crises, it is essential to study economic history. He realized that many events that seem unique in our time have happened before, in different historical contexts. The currency devaluation in 1971, for example, was a shock for Dalio. But when he looked back in time and studied the 1933 event, he realized that the same pattern had occurred under similar circumstances. The study of history is not merely a review of past facts. It is a way to understand the causes and effects that shape markets. Dalio dedicated much of his career to studying great empires and their rises and falls. He identified recurring cycles of prosperity, crisis, and renewal, and how human behavior, greed, fear, euphoria, and panic plays a crucial role in each economic cycle. Dalio also observed that governments, throughout history, repeat the same mistakes, such as printing large amounts of money to resolve crises, which inevitably leads to inflation and currency devaluation. This lesson was particularly helpful for him when navigating contemporary crises, as he already knew what to expect from political and monetary responses. He used this knowledge not only to predict crises but also to build an investment framework that would withstand economic storms. Bridgewater, his company, thrived during various crises because he applied the lessons of history to protect his assets and even profit amid chaos. The impact of debt and money creation. One of the most impactful lessons Ray Dalio learned throughout his journey was the importance of understanding the cycles of debt accumulation and money creation by governments and central banks. He observed that throughout history, governments tend to accumulate large amounts of debt. And when this debt becomes unsustainable, one of the most common solutions is to print money. This process, however, has profound consequences. Dalio explains that when a government prints more money to pay its debts or stimulate the economy, it generally leads to inflation. Prices rise because there is more money in circulation than there are goods and services available. However, this also diminishes the real value of the money that people hold. The result is a loss of purchasing power. He makes a simple analogy. If you borrow money to go to a party, the day of paying the bill always comes. If you haven't produced enough to cover that debt, you will be forced to drastically cut back on spending in the future. Debt is not bad in itself, but if used for immediate consumption without creating future wealth, it can become a significant burden. This cycle of indebtedness is repeated throughout history. Dalio saw this happen during the Mexican debt crisis in the 1980s, during the financial crisis of 2008, and he is observing the same pattern in current markets. With his experience, he has been able to anticipate these movements and adjust his investment strategies, ensuring protection against the effects of inflation and currency devaluation. The importance of diversification in investments. Ray Dalio firmly believes that one of the greatest protections an investor can have is diversification. He often states that knowing how to diversify is even more important than knowing how to pick the best individual assets. Throughout his career, Dalio has developed a strategy he calls the all-weather portfolio. The idea behind this concept is that a diversified portfolio can withstand different types of economic crises, avoiding significant losses while ensuring a balance of risk and return. According to Dalio, diversification means owning assets that are not directly correlated. When markets are booming, it's easy to be drawn to technology stocks or sectors that seem to be growing endlessly. However, he warns that some of the worst returns can come from the best assets, simply because they become overvalued. A classic example of this was the technology companies bubble in the early 2000s, when many of these companies were extremely expensive and ultimately collapsed. Having assets that behave differently in times of crisis, such as gold, debt securities from different countries, and international investments, can help dramatically reduce risks without necessarily compromising returns. He makes a clear analogy. If you lose 50% of your portfolio's value, you need a 100% return just to get back to where you were. Therefore, Dalio emphasizes that a good investor should never expose themselves to risks that could lead to significant losses. The goal, according to him, is to ensure that potential losses never exceed 25%, even in the worst-case scenario. The cyclicality of markets and the study of history. For Ray Dalio, the key to understanding markets and preparing for the future is studying economic history. He frequently mentions that many events that seem surprising in the present have already occurred numerous times in the past. What changes are the circumstances and details, but the patterns remain. Dalio learned two essential lessons from this. First, that seemingly unique events may have occurred several times before in history. Second, that understanding the cause and effect relationships behind these patterns allows him to anticipate crises and opportunities. For example, his study of the Great Depression 1929 to 1932 was crucial for him to predict the financial crisis of 2008, enabling Bridgewater, his company, to profit while most investors lost money. Therefore, for Dalio, studying historical cycles and past crises provides a roadmap to navigate current and future market challenges. He insists that investors need to look beyond their life experiences and study at least the last 100 years to gain a clearer understanding of how markets operate in the long run. The relevance of understanding monetary policies. Ray Dalio emphasizes that understanding monetary policies is crucial for investors who want to navigate a complex economic environment. The decisions of central banks, particularly regarding interest rates and money printing, have a significant impact on financial markets. Expansionary monetary policies, such as lowering interest rates and purchasing assets, aim to stimulate the economy during recessions. However, Dalio warns that while these actions may provide short-term relief, they can also create long-term distortions, such as inflation or asset bubbles. Therefore, investors should pay attention not only to the immediate actions of central banks but also to the long-term consequences of their policies. Understanding the intent behind monetary policies can help investors anticipate market movements. For instance, if a central bank signals an increase in interest rates, it may indicate an intention to control inflation. which typically leads to a slowdown in the markets. Dalio emphasizes the need for critical analysis and constant monitoring of central bank decisions as part of a successful investment strategy. Throughout our journey through the thoughts and experiences of Ray Dalio, it became clear that success in the financial market is not just a matter of luck, but rather a result of constant learning and adaptation. Dalio teaches us that mistakes are, in fact, disguised opportunities. Each mistake we make is a chance for learning that can prepare us for the future. Through his experiences, from his entry into the stock market as a teenager to his ability to predict economic crises, we learn that studying economic history is crucial. The repetition of cycles and patterns in markets offers valuable insights that can help us make more informed decisions. Debt and money creation have profound impacts on our economies, and understanding these dynamics is essential for any investor. Diversification in our portfolios is not just a smart strategy, but a necessary defense against market uncertainties. In conclusion, remember that the knowledge you acquire is the greatest asset you can have on your financial journey. Always be open to learning, reviewing your strategies, and adapting to new market realities. As we always say, education is the key to success. And you, what was your biggest mistake or success in the financial market? Share your experiences in the comments. If you enjoyed this video, don't forget to subscribe and activate notifications for more content like this. Until next time.